Welcome to the deep dive. Yesterday, the 24/7 market engine just like violently hunted liquidity right up to $78,000, hit a brick wall.
Yeah, just plummeted straight down to $75,068.
Right. And in that one cascade, $66 million in leveraged positions just simply vanished.
It was a brutal technical rejection for sure, but I mean, it really reveals this massive structural shift that's happening under the surface.
Exactly. So for you listening, our mission today is to cut through that noise. We've got a stack of recent on-chain data, SEC fund filings, quarterly earnings from miners. We need to figure out what the institutional players are actually doing while everybody else panics. Because look at the retail side. It's a vicious 7-day outflow streak from U.S. spot ETFs. Like over $1.88 billion just bled out.
Total capitulation on the surface. Yeah.
Right. And it looks awful. But wait, if retail is dumping all this supply, who on earth is absorbing it?
Well, that's the thing. The surface telemetry definitely shows an exodus. But if you look at the over-the-counter desk activity during that exact same window,
There's an anomaly, right?
a massive anomaly. Right in the middle of that bleeding, there was a $1.3 billion block trade of the BlackRock ETF, and it was executed in a dark pool.
Okay, so I'm looking at these numbers, and it paints a crazy picture. Like $1.88 billion flows out the front doors, but $1.3 billion gets quietly absorbed out back. It's like watching a panicked crowd sprint out of a burning store while someone is just calmly backing a fleet of moving trucks up to the rear loading dock.
That's a great way to picture it.
But I do want to push back a bit. Is that, I don't know, some nefarious hidden agenda or just standard institutional market making?
Honestly, it isn't malicious at all. It's just highly efficient accumulation. You
Yeah.
have these price-insensitive players using retail panic as like a liquidity smokescreen.
Because moving $1.3 billion through a dark pool means they don't crash the spot market.
Exactly. They acquire massive physical inventory without triggering a flash crash.
Right.
But what's really fascinating here isn't just that physical accumulation.
It's the synthetic architecture Wall Street is building on top of it.
Yes. Just look at the new Direction Daily Bitcoin Bull 2X ETF.
Okay, yeah, I need you to break the mechanics of this down for me because these leveraged funds always trip me up. How does a fund promise 200% daily exposure to a decentralized asset without actually, securing a single private key?
They bypass the base layer entirely. It's all done using over-the-counter total return swaps.
So they don't hold the physical asset at all.
Not a single Satoshi. Instead, the fund enters into a contract with a Tier 1 bank. The bank just agrees to pay the fund the daily percentage return of the asset multiplied by 2. I mean, it's pure financial abstraction.
Wait, hold on. If they promise a fixed 2x return every single day, the math of their portfolio is going to constantly warp as the market price moves. They can't just passively hold those swap contracts, right?
Right, they can't. And that is the structural flaw, which is where systemic risk enters the broader market. It introduces this mechanic called volatility drag.
Because they have to reset that leverage ratio daily.
Exactly. Because the fund must reset its leverage ratio every single day, it's mathematically forced to trade in the worst possible way. If the price drops, their capital base shrinks, so they have to sell off swaps at the close to avoid being over-leveraged.
And if it rallies, they're buying more swaps at the very top just to maintain that strict 200% ratio.
Which means they are mechanically forced into buying high and selling low right at the traditional equities close.
That's insane. As these synthetic derivatives scale up, that mandatory daily rebalancing is going to create these massive price-insensitive waves of buying and selling. And that has absolutely nothing to do with organic demand for the network itself. We are literally turning a peer-to-peer asset into a Wall Street paper derivative.
We really are. And while the financial layer becomes completely abstracted, the physical layer, like the actual infrastructure securing the network, is undergoing its own radical mutation right now.
Yeah, let's talk about the miners. We saw DMG Blockchain's latest quarterly report, and it showed a 25% drop in their mined output.
Right, but they didn't frame that drop as a defeat at all.
No, they're converting a primary mining facility into a 50-megawatt artificial intelligence data center. Looking at this, I just realized these aren't even really crypto companies anymore.
They're highly efficient thermal and energy system operators.
Exactly. They built this massive cooling infrastructure for hashing, and now they are pivoting to repurpose it for the higher margin AI boom.
It's just a pragmatic sector rotation. It's driven entirely by capital intensity. I mean, the sheer cost of competing for block rewards is just forcing these miners to seek better yield for their megawatt capacity.
Which leaves us with this fascinating, honestly slightly unsettling tension to think about. Wall Street fiduciaries are moving all this capital into synthetic paper swaps that never touch the blockchain.
While the very physical miners who secure the network's hash rate are pivoting to host artificial intelligence models.
Right. So if the financial layer abandons physical settlement and the security layer abandons hashing for hosting, what does that actually mean for the long-term viability of the underlying decentralized network? For you listening, think about this is the base layer destined to just become an abandoned highway where everyone trades derivatives on it, but nobody actually drives.